Welcome to Market Directions. This is Joseph Trevisani. We are interviewing today James Chen, an old friend and colleague of mine and one of the best known analysts, technical and fundamental analysts in the business. Mr. Chen, how are you?
Good. How are you, Joseph? Great to see you as always.
It is great to see you. We haven't been out in a while. We have to correct that, but we already have made plans for that.
Yes, we do.
You know, I think your personal history is something which is something most people would find useful because you started out in this business a number of years ago. We'll not talk about how many, with a real beginner's approach to it. And then you have become, over the years, over the past decade and more, a very well known, very well received analyst. One of your quote from one of your books is that most humans are not instinctively good at trading. I think you probably got that from your own personal experience. Can you give us a little bit of your history and how you came about to find out your approach towards trading?
Sure. Well, I mean, it's really, I think, all about experience. I started out, as you mentioned, in the foreign exchange, the currency industry, pretty much when the retail forex industry started, and at that point, the retail forex industry I'm talking about, when it started getting more popular. Now, I got started there. And really, it was a lot of trial and error, as you may know. I mean, it's pretty much you take a look at the markets, you see what's the best way to trade it, and then you formulate a plan around it. And that's pretty much what I've been doing for the past many years. And you know, over time, you find out what works, what doesn't work, and most importantly, how to be able to learn from your mistakes and become as disciplined as possible in your trading.
You know, it's interesting. That's very much the way that I learned, because I'm a few years before that. When I started at the interbank desk back in the late 80s and the early 90s, there was no training. You simply learned, and traders tend to be rather cryptic in their analysis. You don't get a lot of information from them about what you should do. There are a lot of cliches. One of my favorites was, when you learn how to lose money, then you know how to make money, which in the beginning made absolutely no sense to me. Yeah. You talk about in one of your books 3 of the important things that you have formulated as far as ways of looking at the market. One is good analytical and trading technique. The next is good money, actually great money and risk management. And the last is phenomenal discipline. I'm not going to give you my opinion on what those are, what are most important, but how did you formulate that? And what does it mean to your trading?
Well, you know, from the very beginning, I recognized the value of having a very methodical approach. And, you know, at first it starts with trial and error. You play around with it. You think it's the price or the market's going to go up, and then you buy it. You think it's going to go down, and you're going to sell it. But there's really a lot more to that. And you find out, especially beginning traders, they find out pretty quickly that you cannot, you know, have a successful trading career simply by doing that and, you know, going by the seat of your pants. So really, it has to do with, you know, those 3 things that you talk about. It rings true, I think, to this day, and even more so, because, you know, first you do have to have a strategy or several strategies to trade the markets, but that's not the most important thing. The most important thing, I think, is to have risk management and money management and have good control of those. That is the most important aspect of your trading. Why? Because you want to be able to have some longevity in the business. You want to be able to you know, trade a so-called trade or live to trade another day. And that's really so important. And what goes hand in hand with that is the discipline. So, you know, you have to have the discipline to follow your own risk management and money management rules. Otherwise, you know, it's very easy to lose the game from the outset. So, you know, that's most important. So while you know, your approach to the markets on a technical or fundamental basis is very important, but more important than that is to be able to watch your account, watch your risk, watch your money, and be disciplined enough to take care of all that.
You know, there's a book called Zen and the Art of Motorcycle Maintenance.
Yes, I know it well.
You know, and the famous line from that book is, the motorcycle that you're working on is a cycle called yourself. Yes. It's been used many, many times. It's kind of become a cliche, but it is nonetheless true. One of the hardest things to give up, certainly when I started trading on the bank desks, was the idea that you can somehow magically turn every trade into a profit. This is very seductive.
Yeah.
It's emotionally rewarding, and it's a disaster.
It's a
Because
disaster.
markets don't work like that. You know, the markets are not particularly interested in you.
That's right.
Or,
I think you're absolutely right. Yes, and yeah, it's not. It's about. You said it absolutely right. I think that you really have to work on yourself. The markets are going to do what they're going to do, and you have to be able to adapt yourself to the markets, and that's really the most important thing.
that is true. You know, one of the things where we all look at, there are two aspects to trading. We all know this. It's not a revelation to say it. And they do two different things. One is technical and one is fundamental analysis.
Yes.
As you've written, and as everyone knows, technical analysis is based on price action. It's based on a record of prices. It's also the old line: previous performance does not predict future performance. That's absolutely true as well. Nevertheless, the entry point between technical analysis and the market, of course, is psychology.
Yes.
Can you talk about that for a little bit? Because everyone seems to think, and it's very seductive, that there is something there's inherent knowledge in a price chart, and there really isn't.
Yes, there isn't. And that's why over time I've come up with the way I trade is basically I put together both the fundamentals and the technicals, and within the fundamental backdrop you have a thesis of where you think a particular market's going to go, and that's going to be formulated based upon your fundamental perspective, what's going on, for example, with the central banks, with economies, etc. And then from there you take your technicals and you find from a very specific standpoint, you take the technicals and you find out where your entry levels are, where your exit levels are, how long you stay in trades, how you manage your trades going forward, and that's really where the technicals come in. In terms of where your thesis is, that's purely fundamental. What you think, or what the market, or what you believe the market will, how it will react to different fundamental factors, different geopolitical risks, different economic factors, etc.
Is it one of the things that some of the older traders, there were no older traders on the desk in the old days. Everybody was right out of school. Some school anyway. Some of them sometimes, well, no jokes. They used to say, have a view. And I had no clue what they were talking about. Nobody said, well, it's about interest rates. It's about the trade deficit in those days. But this is what you mean. There is a background to the market that informs most trading decisions. Or to think about it another way. Tell me if this matches what you think.
Yep.
So if you're deciding whether to go long or short, and say it's at a 50-50 balance point as far as the chart price action goes, you can't really tell. At the bottom of the panel or something like that. What informs your decision is the overall background from weeks or months before or currently that involves the fundamental aspects of economics and things that you're talking about.
Yes, I completely agree. That's exactly what I think the approach should be for all traders, beginning traders, advanced traders, or what have you. I think most importantly, you need to have a point of view. You need to have a backdrop. You need to have a thesis, and this is this will be informed by what you just talked about: interest rates, central banks, trade deficits, etc. And once you have that, I sort of take a top-down approach. So I'm taking a look first at the overall market. So for example, if I'm taking a look at the euro dollar, I'm looking at mostly I'm going to be looking at the monetary policies, interest rates, quantitative easing, between the Fed and the ECB. And if I see there's divergence there. Obviously, in the case of euro dollar, there's a big divergence in terms of monetary policy. So I'm going to take that first as as a way to inform where my general direction should be. And of course, you have geopolitical factors, including, for example, President Trump, and what's going on in Europe, et cetera. And then you take a look at that. You have a thesis, and then from there, that's when you see when you have your directional bias, and then you decide based upon the fundamentals, based upon mostly support and resistance, and trend, and that's how I take my cues to trigger into trades or to get out of trades, or when to manage my trades, when to be more have more risk appetite or be more risk averse. All of that will be informed both by the fundamentals as well as the technicals.
Could you talk a little bit about the technical tools, support and resistance, and other ones that you prefer, why you prefer them, and also sort of the interplay between the technical analysis price record and how it affects decisions of not just you and me as traders, but as the market in general, which is really the same thing, because the market is nothing more than a way of putting together hundreds or thousands of trading decisions in one place.
Yes. In technical analysis, people always say, the whole story is based on the charts, on the price action. So, you don't need to know anything else. All you need to do is to look at the charts, look at price, and that tells the whole story. I disagree with that. Although I'm a technical analyst, I disagree with that. However, that being said, at the same time, technicals can give you a lot of information. Not the whole story, but a lot of information, and that information is mostly, for me at least, based upon support and resistance and trend. So, if you're taking a look at two aspects of technical analysis that I follow the most, it's going to be, first of all, where's the trend? Where's the trend? Where's the fundamental analysis? I'm sorry, where's the fundamental picture taking us? And then you talk about the trend on the charts. And then from there you have your support and resistance, and that for me is the most important part. Of course, I use other aspects of technical analysis, including I use some indicators, including moving averages, and a couple of those those overbought, oversold indicators, the oscillators, if you will. But most of all, I'm looking at key levels, okay, and that's where the psychology of the market's going to come in, where you have demand at a certain level, you have supply at a certain level, and that translates into support and resistance. And of course, support and resistance can be broken, but then you have what's called a breakout, and there must be something fundamentally driven that allows a market to break out from a support or resistance level. And from there, if there's enough momentum for the fundamentals to do that, then at that point, you have a potential opportunity. Okay. Of course, you also play bounces off of support and resistance as well.
One of the things I've always tried to bring up in talking to new traders,
yes,
is that we have a tendency, analysts all do this, we have a tendency to personify the market. Just the terminology we use, we refer to it as the market, as if the market existed someplace, as if it's some separate entity that makes decisions, and we have to figure out what it's doing and match our decisions. But that's not what it is at all. The market is our own decision multiplied out to 1,000 times or 10,000 times.
Yes.
So you can sort of use your own analysis to enter into that, but it's difficult. Stepping back, one of the things that I know we've spoken about in the past when we've been together has been sort of the reversion to mean aspect of a lot of the oscillators. They all have a tendency to do the same thing, which is back to the middle point. Could you talk about that a little bit, and if you have any particular oscillator that you prefer?
Okay, well, generally I will use the stochastics, okay, stochastics, but just as a sort of an adjunct tool. I'm not going to be, concentrating primarily on oscillators. They give me some indication of perhaps a market is overbought or oversold. But that being said, it really doesn't, because when you take a look at any market, for example, if you look at the stock market, the stock market has been going, the U.S. stock market at least, has been going to continually going to record highs. It's continually overbought. Yeah, it's completely overbought, and markets can stay in overbought territory for a long time. So as you mentioned, the reversion to the mean doesn't always hold true, as the oscillators would indicate, only because there's such a thing called trend, and there's such a thing called strong trends. That being said, how do I use oscillators? Well, when I use oscillators, first of all, I'm not going to be really looking at oscillators during strongly trending markets. What I will be doing is looking for perhaps where I see a strong resistance level, for example. and I see that the fundamentals are supporting a possible turn to the downside. At that point, I will look as a secondary indicator to my oscillator, for example, my stochastics, to see if there's if there's a possible indication of a move down near resistance. At that point, I could take that as an opportunity to get into a short trade. But beyond that, I'm not going to be using oscillators, exclusively, or even have it as my, one of my most important, indicators for trading the markets. Yeah.
Yeah, I've always looked at oscillators as sort of some of the second or third derivative level.
Yes, exactly.
You have a position, and it just adds to the confirmation, perhaps, and adds perhaps to the confidence in a particular trade. I remember one of the classic examples of a turn is, I think it was the summer of 2008 when Jean-Claude Trichet, the euro was at its all-time high, and Trichet was saying we have no problems in Europe from the U.S. subprime crisis. Okay, everybody believed him, so the euro was very high. Suddenly he made one comment that, well, perhaps we have a little more problem than we thought, and the euro just started on a 2-year descent.
Yes. Yes.
And so if you had looked at the stochastics at that point, they're all overbought.
Yeah.
But if you hadn't said something, it probably wouldn't have done anything.
Yeah.
To move on to a little bit more, are there any particular time frames that you look at in charts? You can get charts from from minute charts, you can get out to quarterlies. When you're looking to make a trading decision, is there any particular time frame that you look to, both for analysis and also, more importantly, for confirmation of a decision from one of your other indicators?
Yeah, that's a great question. As I mentioned before, I take a top-down approach. So, for example, I mentioned before, I look at first the fundamentals, and then I narrow it down, I drill down into the technicals. Well, from a technical perspective, I do the same thing. Okay, so basically what I do is, and a lot of people, a lot of people ask me about this. I talk about this all the time. What I do is I take the a top-down approach with technicals as well in terms of time frames. So what I'm going to be looking at, first of all, are the longer-term charts. I'm looking for the trend, okay? And then I'm going to be drilling down to progressively lower levels. So for example, I'll go from the daily chart, I'll look at the trend from there, or even the weekly chart at some point. And then I'm going to drill down perhaps to the 1-hour chart, okay, if I'm looking for some type of an entry. And then perhaps what I could do, what I often will do, if I'm trading from a shorter term perspective, is to be looking at the shorter term charts. So and that's where I'm going to take my specific entry. This is not to say I'm day trading. What it is to say is that I'm looking for, for example, from the longer term perspective, I'm looking at the trend. On a shorter term basis, I'm looking for support and resistance levels, possible triggers to get into trades. And on the very short-term time frames, I'm looking to drill down into more specific, shorter-term support and resistance levels in order to try to pinpoint as good a trade as I could possibly get.
It's interesting. Our history in trading markets is entirely different.
Yes.
Yet we have come to a very similar, because I was just thinking, as you were talking, I was just thinking about this is very much describes the type of analysis I used to do when I was trading. We don't trade here. I would look for the overall trend, and then I would look down for the price action to see where it could be confirmed. If you find something on a daily chart, but then you want to make sure that the price target that you're aiming for, there's a lot of back and forth price action at that level, because that will tell you there's a lot of indecision.
Yep.
And so people on one side, people on the other. When you use indicators, how do you actually come about with a setup? Looking for, do you use chart patterns, the old-fashioned chart? Because you can find chart patterns very similar on both. And another question, actually, I'll fold it in. Do you prefer using the more old-fashioned, as I used to, bar charts, or do you go with the more modern candle charts, or at least the more?
Yeah, let me answer the second question first. Definitely I use candlestick charts. Now, in terms of the difference between bar charts and candlestick charts, they tell the exact same story in terms of open, high, low, close. But the candlestick charts give a better visual representation, I think, of price. So if you have, for example, a green candle and a red candle, you could tell right away in terms of the representation of bullishness or bearishness in that particular candle. And that for me is useful. So if I'm going to be choosing between two types of charts that provide the same information, open, high, low, closed, I'm going to opt for the one that gives me a slightly better visual representation.
Yeah,
now,
I agree with
yeah. Now, the first question you asked regarding, how do I formulate my, my trades, et cetera. What I will do is, and, I talk about this all the time as well. I put together a system based upon what's called confluence, which is, a coming together, a combination of factors. So, again, going back to the combination of fundamentals and technicals, I'm going to look at both of those for them to confirm my directional bias and my possible entry points and exit points. Now, from a technical perspective, I'm going to be doing the same thing. I'm going to be looking at it from a confluence perspective. So, for example, like you mentioned, if there's a chart pattern, okay, if there's looks like there's going to be an imminent breakdown of this particular triangle pattern or whatever, I'm going to look there, and then I'm going to look to confirm, is that also a key support level or resistance level or what have you. And then I'm also going to look at my oscillators. Are we emerging from overbought or emerging from oversold? And putting together all this, arguably, from my point of view, gives you a better chance of having, a better entry point, a better directional bias, etc.
One of the things I always tried to do was to sort of enter into the mind of everybody who's looking at the charts, because after all,
yes.
we're all looking at the same charts,
yes.
and most of us are coming to the same conclusion. So this is a real entry point for, I think, for beginning traders, when it seems that the market is the market. What's the market? It's some big monster that lives underneath Wall Street and does things, and you have to figure it out. But that's not really what it is. So your own trading, this is a point I always try to make. Your own trading is the entrance. Your own analysis is the entrance, because what's happening is the market is duplicating your same decisions, your same analysis across 50,000 traders. Therefore, we get movement.
Yes, exactly. And I agree completely with what you just said. In a way, looking at technicals, a big part of it is what's called the self-fulfilling prophecy. Basically, everyone's looking at the same charts. So, if you see 105 on euro dollar or 102 on pound dollar, everyone knows this. So we're just looking at the charts. Yeah. Yeah, so we're looking at the same charts, and and just because of the fact that everyone is looking at these charts and reacting upon these specific levels, then you get what's called the self-fulfilling prophecy, where something tends to happen around those levels.
Yeah, I even have a quote to support that. I was actually reading through something that Steve Nissen had written. I think you know him, both of them.
Yes, definitely.
And he had quoted in one of his. Actually, you quoted it in your book.
Yes.
It is not the news itself, but it is the market reaction to the news that is important. This is absolutely true. This is the old cliche.
Yes.
Buy the rumor and sell the fact. It's exactly because it's already factored in. I want to move a little bit to your view of current things and the fundamental aspects of what we're talking about. Probably the biggest news out there right now has been what the Fed has been talking about. You have almost every Fed governor, including the chair, Janet Yellen, lining up for a March rate increase. A month ago, the odds from the futures on a Fed rate increase in March were probably around 30%. They're now well over 70. You can make an argument that the Fed is well behind the inflation curve. They are trading in the Fed funds top rate. The target rate is 0.75. Inflation, if you put together both the PCE and the CPI, it's probably around 2.21, 2.2. Just on that argument, you would seem that the Fed's behind the curve. What do you think about this? And what do you think of the Fed policy going forward?
Okay, well, that's a great question. I think that I think that the hawkishness in the last just 2 or 3 weeks alone the increase in hawkishness has just been phenomenal. And yes, and right now, last I saw this morning, I think the Fed fund futures were pricing in around an 88% probability likelihood of a March rate hike.
Yes.
Yeah, so I think it's very clear that they're behind the curve in terms of keeping up with inflation, especially with respect to future expectations of inflation with Trump in office, and I think that's a huge part of it, because of the political aspect of Trump, with his infrastructure spending. Inflation expectations are going very high at this point, and I think they really need to raise rates. And but in terms of the rise from, I think, from 2 weeks ago, the Fed fund futures were just pricing in around a 20% or so. Yeah, so this rise is I don't know if it's unprecedented, but it's pretty fast. So I think that bodes well. It bodes well for the dollar, and it bodes not so well for gold, I think. And going forward, yeah, I think we're going to see that. And in terms of the future, the outlook for rate hikes, I think it's going to be accelerated. I mean, they talked about 3 rate hikes in 2017. Back in December when they were, provided their outlook. I think it's probably going to be more than that.
It's interesting. Everybody disbelieved the 3 hikes because they said there were going to be 4 the year before, and they ended up with 1. Yes. I mean, the acceleration in rate increases from 1 in 2 years to 3 or 4 this year, it's astonishing how quickly people have changed their minds. Another interesting fact is that for a long time, the Fed has said, and I don't mean this to be particularly critical of Fed policy, the Fed has said that the economy is essentially too weak. Otherwise, why raise rates?
Yeah.
I mean, why not raise rates if it's not too weak? Suddenly, the economy hasn't really shifted. We're still growing about 2%. The latest first quarter estimate from the Atlanta Fed is 1.3%.
Yes.
That was out yesterday. Suddenly, the economy can support all of these rate increases. It's a very interesting shift.
Yeah, I think it's also the expectations of where the economy is going. With Trump in office. I mean, really, the markets have really cheered Trump coming in, and to a certain extent, I think a lot of that is unwarranted at the current moment. We don't know what's going to happen with the Trump administration, but the markets have really raise their expectations for growth and for inflation, et cetera. So, I think with respect to that, the Fed is also sort of jumping on board and seeing that the expectations for growth are much higher, and therefore, we get this huge leap in hawkishness from the Fed.
The Fed had been criticized a long time for basically following the markets. That certainly seems to be a case of the right now. One of the things interesting, I looked up the change in 2 markets, in the Dow as emblematic of the equities, and the DXY as the dollar strength since November 8th, which was the election, of course. And the Dow's up 16%. About the dollar, the DXY is only up 3.4%.
Yeah,
there would seem to be, as you say, some potential for a catch up there.
Yeah.
So to formulate the question, do you think that 3 and perhaps more rate increases are factored into the dollar level yet?
Oh, yes. Okay. Yeah. We saw, for example, the ADP come out this morning at 298,000. So, that even more so increased the probability of a rate hike. But we did see a rise in the dollar, not a huge rise, because I think you're right. I think a lot of the 3 rate hikes, or the expected 3 rate hikes, has been already priced in to the dollar. That being said, though, I do think that the dollar is well supported. Whether it shoots up from here just for the fact that we have 3 or 4 rate hikes, I don't think that's necessarily going to be the case. But we do have good support on the dollar, but I think more importantly, we're going to be seeing gold, further pressured as rate, as the interest rates rise even further.
And just one last comment before we end, we have there's certainly some potential volatility and turmoil going to be coming out of Europe this year. We have the French elections, the 2 rounds in March and May, or April and May, and then we have the Dutch election in March, and then we have a potential Italian election, then we have a German election.
Yes.
That's a lot for the markets to absorb. Do you think some potential disruption from these elections politically and for the political settlement in Europe has been factored in yet?
I don't think so. I think that, you know, in terms of currencies, I think that the euro has much farther to go down. You know, I'm of the camp that, you know, a lot of people are saying euro dollar at parity. You know, I think that's that could very well be the case. I mean, you talk about these elections, we have. You know, we have a wave of populism, nationalism, and a lot of that is anti-EU. And you know, you talk about the French elections, and you know, with Marine Le Pen, if she wins, and then we have the Dutch elections. You know, if we have any, you know, if we have much more threat against the you know, the EU and also the Eurozone, then at that point, I think we're going to see a lot more potential downside for the euro going forward. And you know, for now, and you know, and adding on to that is the you know, the hawkish trajectory of the Fed. You know, you put that together, I don't think euro dollar has, you know, has very high to go before it starts to really tank. And that for me is a very strong conviction because of what's going on with the geopolitical risks, as well as with what's going on with the Fed and also the ECB.
I agree. Mr. Chen, I thank you very much. We do have to end. It has been greatly appreciated, and I think everyone here has enjoyed what you've had to say, and we will do this again, and we will have dinner very shortly.
Great. Thanks so much, Joseph. I really enjoyed it. Thanks a lot.
Bye-bye.
All right. Bye-bye.
That was fun. Hi, is anybody there?